Hey everybody, Scott DiGregorio and
Gardo Valentine.
here from Primary Residential Mortgage with our weekly live. Dude, you got to step over this way. You're not my camera.
Oh,
See, we're already screwing it up.
All right, we're in Fort Myers today.
And so let me start, man. There's actually a lot to go over this week. So first thing I want to talk about is I was able to close a Save Me deal from a builder.
Okay, what's a Save Me deal?
So a Save Me deal, somebody else turned it down and I didn't. So we've talked about this a lot. In this case, it wasn't a special program. It was literally just knowing just kind of how to manipulate and squeeze a round peg into a square hole.
Okay.
So I was able to do that.
Or something like that?
No, nothing fancy at all. It was just a matter of doing some stuff with the taxes and credit scores and whatnot. Feel pretty good with it. Another Save Me deal I just realized I got. Somebody else had turned it down. The agent uses me and another lender. I don't know why that is.
Yeah.
But anyway, sent it to the other lender.
Like
The other lender turned it down because they had a higher minimum credit score for FHA than we do. So we've talked about overlays.
Okay, so just for everybody watching, an overlay is when a bank decides to put requirements over the minimum requirements that the agencies put in. So for example, FHA, if FHA says, hey, you need to have a minimum credit score of, 580 to put 3.5%, then the bank can come in and say, that's fine for FHA, but for us, it's going to be 650 or 660.
Or whatever it is.
Right.
Yeah. So in this case, their minimum was 620. We don't have a minimum as long as we have AUS approval. So anyway, two Save Me deals I feel pretty good about.
That's awesome.
Yeah,
That's
pretty
really
cool,
nice.
man.
That's
What
really
about
cool.
you?
Well, I have this really cool program that I was able to put 3 of my clients from last month in, and the way it works is they have to put only 3% down in order to get into a home. It's a conventional home.
Sure.
It's a conventional loan. They have to have that mortgage insurance because it's less than 20% down.
Always.
But the mortgage insurance is reduced, so it's a discounted morttage insurance, if you will. It has a better rate. And on top of that, it has an insurance for an involuntary,
There we go.
I love that word, for an involuntary job loss for up to 6 months. So what happens is in the next 2 years, whatever, they lose their job, that mortgage insurance is going to pay for their mortgage for up to 6 months, up to $1,500 a month.
Yeah.
How cool is that?
Yeah, that's awesome. And let's talk about why that's even more awesome now. People now are starting to talk about unemployment. It's rising. People are starting to lose their jobs. So where this was maybe less exciting 2-3 years ago, I think sitting here in 2019, it's exciting.
Well, not even going that far. Think about all these people that worked for the government with the government shutdown. With something like this, they would have saved them. And the cool thing is that the up to 6 months that we're talking about don't have to be consecutive. So you can use, let's say, the government shut down for 3 months or whatever. It's going to pay for those 3 months. And then if that happens again in 2 or 3 years, it's going to cover for another 3 months. So it's huge. It's a no cost for my clients.
I was just going to say, how much extra is this?
It's a no cost for the client. So it's actually a better loan, low down payment, low mortgage insurance, low interest rate, and more protection for them. Absolutely. So I was very happy to explain that to my clients, and it's an awesome program.
It is, and it kind of dispels the myth that all first-time home buyers should get into should go FHA.
That's right.
There's cases that's true, cases that's not. It's all about structuring.
Well, the one thing that you have to do extra, that they had to do extra, is take a home buyer's education class. Which, by the way, if you go to the actual class and you take it in Spanish, I teach it.
There we go. And look,
and it's free if you go.
Now look, it's not. That's not a negative in my opinion. More education is the better. It's an extra step.
It's an extra
but
step.
I think it's a positive step.
Yeah,
I really do.
So very happy about that. Very happy to make those calls. I thought it was an awesome program.
Yeah.
And to give them that protection is great.
It really is.
Yeah.
And speaking of programs, and this kind of wasn't on our list, but it just crossed my mind.
Okay.
What's up with that email we received this morning?
Oh my God, that's so exciting. So, no, it's not out yet.
No. But in the next couple weeks, we're coming out with a conventional 105% loan. So what does that mean? You can actually finance 100% of the purchase price plus finance in the closing costs, subject to restrictions and approvals and all the fine print stuff.
Right.
But look, here's what it tells me. Programs are really starting to expand now. For years and years, everybody had 4 programs. We now have dozens and dozens of programs.
Yes.
Our competitors do as well. And folks, this is a good thing.
Yes.
This is a good thing. So
It is good. Because everybody's situation is different.
100%.
You know what I mean?
100%.
And if we have so many options, then we have the ability to put them in the right bucket for them.
Absolutely.
And I always go back to this. It's not just a matter of whether you qualify or not, but what's the right program for you.
100%. 100%.
So it's cool. Yeah, I'm excited about that 105. As soon as we have it available, we'll probably do a
we'll
live
watch it.
and we'll do a video and we'll explain a little bit about it.
Absolutely.
That's gonna help a lot of people. 105, it's great.
It's big. It's big. So the other thing I want to talk about, and I literally just ran the numbers an hour ago.
Okay.
Clients call me up, hey Scott, I want a 20-year mortgage.
Okay.
All right. And as you know, you can do mortgages, right? 5, 10, 15, 20, 25, 30. But what I tried explaining to them is that the interest rates really get the drop when you get into a 15-year mortgage.
Into 15.
So what I did was I just sent them over numbers looking at both a 15-year and a 20-year. The 15-year mortgage was 0.5% less in rates.
Okay.
And over time was going to save over $30,000 in payments. So, it's important that as loan officers, we don't just take orders for what our client, right? What I call being
That's
a
right.
drive-through lender.
That's right.
Let's go with our knowledge, our expertise, and let's try to structure them. It was going to raise that client's payments about $150 a month. But again, even factoring that in, with saving the 5 years, saves them $30,000, just no brainer.
Yeah,
Just
that makes sense, and it's important too when we present this. We do like a total cost analysis, right? We explain to them what the pros and the cons are, what the cash flow is going to be, and at the end of the day, what the overall savings is going to be. So that's great, and it's true. Going from 30 to 20 doesn't necessarily make sense. At that point, you might as well just keep your 30-year mortgage and figure out what the extra payment is going to be, and just save that amount of time. But if you can do the jump to 15, and if it works out with your situation and the cash flow, it really is a no-brainer.
Yeah, and look, here's a tip for everybody listening to it, right? So what we're talking about is the spreadsheet method. Yes, the math works to take one option over another. I'm big on what I call the livability factor. If that extra $150 a month makes you uncomfortable, then who cares what the spreadsheet says if you can't sleep at night over stress? So you have the spreadsheet method and the livability method, and through those two, you could usually find out which way you want to go.
And at the end of the day, we're not making the payments. The clients are making the payments. So we'll give you all the facts, and you make the decision based on that.
All right, so I'm going to talk. I want to talk about stats. So those market stats came out. Woo!
Yeah.
All right, so check it out.
They're not pretty.
It's no worse than last month, and what we're looking at here is January stats, and check it out. So closed sales, comparing January of 18, January 19, closed sales are down 18.7%, single family homes, down 18.7%. Active listings is up 18.9%. Pending sales is down 11%. So inventory is up 12%. The amount of time it takes to go on the contract has increased by almost 12%.
Yeah, and just to add, that's not in that particular statistic, but if you go to the MLS and you look at the amount of properties that have had a price reduction in the past week, it's crazy. I've done it, I think, in the past month, and it's about 2,000.
Yeah,
it's crazy.
It's real. So look, don't let this freak you out, right? The market's starting to adjust. Again, we've been saying this for a long time. This is not going to be this huge collapse. This is literally just going to be a little bit of a market correction. What was happening for a long time is, the last house sold for 300, I'll list mine for 310. I'll list mine for 320. And this race to the top thing has been going on for a while.
Let me take a look at this real quick.
Those days are over, okay? If the last neighbor sold the house for 320, it is not automatic that you're going to get more than that. So things are starting to adjust down. I don't see it really scary.
We'll address that.
Arturo's asking a question. What's the name of that program again? Arturo, I'm assuming you're asking about the 105% program. Honestly, it's called the conventional 105% program. And that's what it is. So we're working on developing that. The program you were talking about as far as the job loss protection, that's just an added component to our MI.
That's an added component to it from our MI.
It doesn't have a specific name.
It doesn't have a specific name, as long as they put the 3 and 5%.
Absolutely. And shout out to Shane. Hey, Shane, how are you, man? All right, so stats.
Yeah. So we have this. Let's just talk real quick about our buyers.
Sure.
Right. So what does this mean to our buyers? There's more inventory.
Mm-hmm.
They're gonna have more options. One of the stats that I want to point out is even though there's more inventory, the percentage of the houses that there was the percentage of the house that sold versus the listing price, it dropped a little bit. It dropped 0.4%, but it's 95.3%.
Still.
This means the houses are going for about 5% below the asking price.
Assuming it's priced right, and we've all seen properties that were disgustingly overpriced. So if it's priced properly, yeah, we're at about 95%.
So, what we got?
Yeah. So sorry, Arturo's coming back.
That's a conventional loan that we have. It's a conventional loan that's just at 3%. There are a couple of things that are specific to that loan for in our end, some places, some particular areas are going to have income limits, but not all areas. But it's just one of the conventional loans that we offer.
Absolutely. And look, keep in mind, within this world, there are some programs we offer and some programs that are out there, right? Loan programs like Home Possible is out there.
Right.
Home Ready is out there. And we have those as well, but then we also have some proprietary products that we're
And then we also have some added bonuses like the mortgage insurance
100%.
that comes up with
Absolutely.
those conventional loans. So anyways, the point here is, guys, even though there's more inventory and even though we're hearing that it's turning into more of a buyer's market, this doesn't mean that houses are depreciating, or this doesn't mean that you can go on and offer 10% or 20% below asking price, because this is not the market we're living in right now.
No, and look, 6 months of inventory is defined as a balanced market.
And how much do we have?
We had 5.8 last year. We're at 6.5 this year. We're still right around the balanced market. So don't let the numbers scare you. I think it's a good thing. Now, you had a situation about work history. I know you want to talk about it.
Yes. So we had a question about work history, and this is a very common question that I get not only from the clients but also from realtors.
Absolutely.
Right? So if there's realtors watching right now, please don't decline people if you hear that they just started working in their company, because that's not a set rule. That's not set in stone.
It's not.
Right? It's when every time somebody talks to me about how long do I need to stay in this job in order to be able to qualify, the first question that comes to mind is, how do you get paid?
Exactly.
Right? What type of income do you have? Is it salary? Do you get paid hourly? And is it 40 hours a week every time? Is it consistent? Or are you self-employed? Are you commissioned? Right? Because we're going to treat this income very differently. If the income is variable, like a 1099, a private contractor, a self-employed person, commission, tips,
overtime,
anything like that, then we are going to need at least a 12-month history.
At least. Yeah.
We like
if not
to see
24.
we like to see a 24-month history, but we've gotten away with 12 months.
In some situations.
In very particular
Yeah,
situations.
some situations.
And this is what's nice about working with the underwriter, because we go to them on the pre-call stage and he can look at everything and just tell us, look, we're really going to need 24 months for this person.
100%. And that I had a situation this week too. A woman's back at her job for 13 months, did not work for 5 years before that, but before that she had her job for 8 years. Well, look, she was taking the time off to take care of her children. I won't get into details, obviously, but to take care of her children. I got a letter of explanation, and even though she's not on a job 2 years and she had a big old gap of employment, it makes sense. And prior to that, I was able to leverage that prior work history. So, look, it's you know as well as I do, Ed, it's all about the art of structuring the deal.
Right, and it's a lot more aggressive than we think and than we hear out there, because I mean, I know that we love to read guidelines, and we see that for a conventional loan, it is possible to get into the loan, to close the loan, as long as you're going to do it within the next 60 or 90 days.
Yeah,
as long as you're going to start the work 60 or 90 days after we close the loan. Now, these are very, very specific situations. We need a very specific contract that explains a lot of things. But it's possible.
Look, it's possible, and I've done it. And look, it's not the rarest thing in the world. Like if you look in the medical industry, most of the people that I've seen that work at Lee Health, nurses, doctors, etc., they have contracts that they work on.
Or teachers.
As well as teachers, big companies like Arthrex and Gardner and Hertz. And I mean, it's not this, 1 out of 1,000 people.
No, not at all.
It's just, it works for a chunk of industries, but not all.
Yeah, and the other cool thing, and I know we talked about this in our video series, which we're going to give the link afterwards, but is if somebody is a first-time home buyer, let's say, and was in school before, even if you're not a first-time home buyer, but if you were in school before or doing any particular training towards the job that you just started, that counts for as employment history too. So the point is, guys, you do not have to wait 2 years in order to qualify. If your situation, if your circumstances right now are right, don't wait 2 years in the same job because you think that that's the only way that you can get into a home.
Absolutely.
That's just not the case.
Absolutely, that's not the case at all. Now, you mentioned video libraries. So I want to talk
Yes.
about that. I'll start. I'm super excited. So look,
Yes.
for those of you that haven't seen it, please go to FloridaMortgageExpert.com and check out my video series. I currently have an entire page on FHA.
Or askyourfavoritelender.com.
Wait, hold on. Wait. This is me. But look, FloridaMortgageExpert.com. I have a whole page and a series on FHA, another whole page on series on VA, and here in the next handful of business days, I'm going to have my first-time homebuyer page up there. Look, if you are a potential buyer, go watch those videos. They're amazing. They give a lot of little details.
If you know a potential buyer,
right? If you're
share
in the
this to
business.
them. Share this to them. If you're in the business, if you know somebody, a cousin, a son, anybody that maybe wants to buy a house in the next 2-3 years, in the next 6 months, have them watch this because we're going to cover both in his page and in my page. We're going to cover not only specific programs like the one that we were talking about, but we're also going to cover buyer profiles like first-time home buyers, move-up buyers, reverse mortgages, things like that.
There's a lot of stuff, and we're even going to go into some personal finance stuff, household budgets, and how to do a needs versus wants analysis and looking for a home. Just
That's right.
a lot of details there. So
Yeah.
FloridaMortgageExpert.com or visit me on YouTube, Fort Myers Mortgage Expert.
Or askyourfavoritelender.com, and I'm going to be putting videos, the same exact videos in Spanish as well.
That's fantastic. Now, the last thing we're going to talk about is the successes of our lead program.
Yes. So tell me about your successes.
Man, I tell you, it's been exciting. So for those of you that probably put it together, we have a pretty comprehensive program to kind of reach consumers and educate them. Some of those consumers are trusting us with their finances, which means the world to us. Just this week, I was able to successfully close a lead that I was a handover to Dina Linhart over at the Hudson Warren team.
Nice.
They did a great job. I sent them over. They were able to find them their dream home in under a week. We were able to close it in under a month, and that's my first success. My second one was another lead that I was able to give. I gave it to David Mulligan out in Lehigh, Realty World. What's up, David? And he has done a great job with her. Took them about 2 weeks, but I was able to take her application today.
That's nice.
She's a first-time home buyer. By the way, I mentioned earlier somebody else was had different credit scores. Same thing. She was turned down by somebody else.
Okay.
And she met our guidelines. And dude, I'm stoked, man. 2 successes
awesome.
this week. How about you?
It's cool. I have one success this week, and it's cool because the people that maybe that reach to us on Facebook and reach to us online and all of that is people that have been following our videos for a while, and it's really cool because there's a different type of connection that I feel with them. Right now I have a lady that's been following me for a couple of months. I was able to hand her to Amber Reyes, which is an amazing realtor. So she took great care of her. We're under contract right now for about $295, and look, everybody's happy.
Absolutely, man.
Everybody's very happy.
So look, if you're a potential home buyer or seller out there and you're looking for a good real estate agent, there's a lot of agents and not all of them are good. So reach out to us and we could give you some names and help make sure that you work with somebody that fits for you. If you're an agent out there,
that's an expert in the area that you're looking for.
Yeah.
Because it's not the same to buy something in Golden Gate City than in Lehigh.
Absolutely.
It's different.
Yeah, there's little nuances, and those nuances make a difference. And if you're an agent out there and you have any questions about us and what we do, reach out to us. Otherwise, dude, I think we're good, man. Let's go next week.
Yeah, absolutely.
All right,
Tune in, guys.
Take care, everybody. Send us questions.